Good day, Market Chameleons. Everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage, who will be talking about tracking call option costs with an index benchmark. How you doing, Dima?
Good morning, Will. How are you?
Good. Let me share your screen, and let's get rolling.
Yeah. So, well, first, let me navigate to the screen, and then we'll talk about how can we track the cost of a call option in a particular stock, so we have an idea in what are the values like currently. Are they on the high end or low end of the historical range? And when we look at calls, we have all these different options and different expirations. So we have to kind of create a benchmark, some kind of standardized benchmark that we could track and make it easy to kind of assess, are we, elevated right now? Are we on the lower end or cheaper end of the historical range? So let's go to Google. So I'm going to go into the search box, type in Google. It'll take us to Google's main summary page. And on the left-hand side, let's click on options. And under options, we're going to click on strategy benchmarks. Okay, so we come to this page. I'm going to click on this menu to minimize it. And we have all these different strategies up top. You could see risk reversal, straddle, strangle. So I'm going to slide over because there are different types of strategies. But we're going to look at a long call. Okay, I'm going to click on this, and we come to this page. And when we first try to track a option strategy, we kind of need to define a few things, because options have expirations, right? So when we're talking about their contracts with expiration dates, and you could have an option with 5 days to maturity, 10 days, 20 days, even a year. So when we talk about different maturities, they're going to have different premiums, because you have time premium based on the days to maturity. Okay, so even when we look at things like interest rates, you might have interest rates where you can borrow 1 year or 5 year or 10 year, and you're going to have based on bonds that mature further out will have a different interest rate than maybe something that matures in 3 months or 1 year. So first we have to define, the maturity that we're benchmarking. So here we have a 30-day maturity. Okay, so this is an option with 30-day maturity is what we're benchmarking, similar kind of to the VIX, where we're looking at 30-day maturity. Okay. And also with options, we have different strikes. So when we talk about, tracking an option, you could have an option that is very far away, an out of the money option. So if a stock is 100 and you're looking at a strike that's 150 or 200, you're talking about, an option that's 50 with a strike 50% away or 100% away. Or you could have an option that is equal to the stock price and at the money, right? So if the stock's at 100 and you have an option that is with a strike price of 100, we call that and at the money. Okay, if you have a strike price if the stock's 100 and you have a strike price of 105, well, that's net of the money because the stock has to go above 105 for that option to be in the money. So it needs to increase by, more than 5%, right? It needs to increase by 5% from 100 to 105 just to hit that strike, and it has to go above it. So we have to define that as well. So in this case, we define 30-day maturity and then at the money, which means, that we're looking at an option that that the strike price is equal to wherever the spot price is. Okay. So if I slide down, for example, here, this benchmark looks at 30-day maturity with a strike that is 5% above that the money. Like we said, if the stock's at 100, it's looking at a strike that's 105, right? If the stock is 200, it's looking at a strike of 210. So has to be 5% above where the spot price is. Okay. So now that we defined this, right, we need to create a benchmark. So we know, okay, this is what we're looking at. Similarly, like if you're looking at interest rates, you have to define, oh, I'm looking at a 30-year treasury, or I'm looking at a 15-year treasury. So now you're defining what you're looking at. But you could look at a 15-year corporate bonds. You could look at a municipal or whatever. So that's what we're trying to do. We're defining maturity and what we're looking at. And now that we defined it, we need a benchmark, right? So a benchmark is because we don't have an exact 30-day maturity at the money option every time, right? Like that's the stock's moving around, the options, even if it's 30-day, even if they listed a 30-day today, tomorrow it's 29, it's 28. So we're going to have to create a benchmark, just like interest rates, where you have, corporate, what are the benchmark interest rates for corporate bonds or treasuries or whatever. It's an index. There's not an exact bond that you're going to be able to track every day, right? Those bonds also have maturity. So we create this. So we have to create a methodology and something that we could, kind of reference and even compare across similar securities. So in this case, what we're doing is looking at a methodology of looking at the options that straddle 30 days. We stick to this calculation, this method, and we convert that premium. How do we, we can't do it in dollar terms either, because, we can't say, well, here's a $3 option, it's $3, but what does $3 mean? Because if the stock is moving around, if the stock's $100, paying $3 for an option is different than if the stock is $10 and you're paying $3, right? Because that's for, if it's $10, you're paying $3 for not the money option, that means it has to move 30%. If the stock is 100 and you're paying $3, well, that's only 3% move, right? So we need to convert that option value relative to the stock price. So what is the premium relative to the stock price? So that's what this is, 3%. Okay, so wherever the stock price is, multiplied by 3%, that's the premium. And this way we could just track it over time, because now we're tracking what the cost of that option relative to the spot price. Okay, that's what we're doing here. So now that we have this benchmark, we could see how it changed over time, right? And then you could, even if you wanted to, or if it's easier for dollar terms, just say, okay, for 100, if I normalize it to $100 worth of stock, it would be $3 to buy that option, right? So it's 3%. So you could see how that looked like over time. So you see changes. It's not always the exact premium, right? And think of it as an insurance policy, that to insure a car, it's not always the exact, right? You're going to get, if you call different insurance companies, you might get something, different. And sometimes, they'll go up, they'll go down. It's not always exact. So it changes, right? Based on different factors that they're putting in there. Just like options will change based on different factors, volatility or, earnings and stuff like that. So we could see here that it changed. It had like this big, up here, big spike. If I hover over it, it went up to 5.7% of spot. Then came back down. And right now it's at 3%. So how does that 3% compare to history? We're eyeballing it here, but one way to do it is take the 52-week average of all the values, draw a line, and then we'll see, okay, right now we're kind of right at the line. Looks like, we're right at the average. And here it says 52-week average, 3%. And if we want to see the change on the day, this is the change. So did it go up from the previous day? Did it go down on the previous day? So this lets us know how the trading activity and the different market, dynamics, what happened from the previous day, just like we track stock, right? We try to track the changes. So we do usually from day to day. What did it change from the previous day? So it was up a little bit yesterday. And another way to kind of, so one way is comparing it to the average. The visual, by graphing it, it lets us kind of just eyeball how much variability there is around the average. Like where's the high, where's the low, and how much does it tend to move around, just visually, a lot, a little, so if it moves a little, then we would see the line very close to the average, right? If it didn't move at all, then all these observations would be one straight line on the average. But we see there's variability, and it shows us, how far away it tends to move around that average. And another way to look at it, besides the average, is if we took all the observations. So if we took the most recent one and said, okay, how does the most recent one compare to the previous observations? So if we took all the previous observations, and for the last two year, 252 days, and we sorted them from highs to lows, right? Let's say we sorted them from highs to lows. We have 100 observations. So to make it easy, let's say we have 100 observations, and we looked, and then we said, okay, right now we're at 3%. And if we look at 100 observations, we say how many of the last 100 were below 3%, how many were above. So this gives us kind of an idea how often it stays below, how often it stays above. So that's what this is, 59 percentile rank, meaning 59% of the historical observations in this graph were below the current level, and that means 41% were above. So this quickly gives us a chance to, while we're looking at a particular stock, or we want to compare it to a different stock, or we just want to know, where we're at right now. Where is the market at relative to history. It's a quick way to come here, because it's from the options chain, you're not going to be able to do this. So it's a quick way to look at a benchmark similar to the VIX, similar to what the VIX are doing. Look at a benchmark and get an idea, are we on the high end or low end? So just like if we wanted to look at an out of the money call, 30-day maturity with a 5% out of the money call, we could see that one's also 1.1%. So makes sense. It's going to be less premium because you have the out of the money call is cheaper than an at the money call, right? So less premium, 1.1%, which is also near the average, and it's in the 64th percentile rank. If we come down, we could look at a 60-day, so further out at the money, 60-day out of the money, 90-day out of the money. Okay, and this is again using a benchmark, just like we use, in finance, lots of benchmarks. VIX is a popular one, to quickly look at a stock and get a sense of how those option premiums, how the markets are pricing it currently relative to its history. Okay, well, I'm going to throw it back to you.
Yeah, that was a great webinar to end the week, D. Thanks for bringing that to the Chameleon community, and thanks for bringing these webinars to the Chameleon community. You have a great trading day, my friend, and a great weekend.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day. Have a great weekend. We hope to see you Monday.
All right, we'll see you Monday, D. Thanks, buddy. Bye-bye. All right, everyone. Thanks for joining the Market Chameleon webinar series today. Hope you enjoyed today's webinar. Remember to like and follow us on all the social platforms. If you're new, remember you can go to, well, if you're new, you wouldn't remember, but you can take a 7-day free trial. Just click on the free trial button, input the needed information. That's always appreciated. Remember, again, to thumbs up on YouTube if you're on YouTube. And we'll leave with a little look into Swami's backyard, the beautiful swans this morning. Hope you're feeling better out there, Chuck. Everyone have a great weekend, and thanks for joining the webinar series. Have a great day. Bye-bye.